Did it go live? I didn't even notice that it went live. Ladies and gentlemen of the crypto space, we're live on a Monday, May 23rd at 11:32 a.m. It's a hot topic. We're still in a very bearish market. We can look at the technicals and see we're at bottoms. And the holy question of all questions is it the bottom or is it just a pit stop on the way further down? And that's obviously from a capital gains perspective, but we talk almost predominantly on this stream about looking at these markets from a enterprise ownership, a cash flow management perspective, which I find much healthier and sustainable than merely capital gains. And obviously, many folks have mentioned in the YouTube commentary, like we didn't start with just cash flow management. We talked about capital gains over the course of 2020 and probably even early 2021. There were some plays that we talked about regarding that were opportunistic capital gains plays. Now it's nice to make money like that, and you don't have to, and that's really why I've focused on the way I look at markets like nowadays. It's changed, and obviously many persons could argue that how did I make money? How did I make my money? Through capital gains, and now I have a different strategy. But in the end, um, how people make money, whether it's work, savings, time, converting labor into time, or capital gains, you'll find yourself always with a choice between how you want to spend your time, whether it's frustrated with anxiety, trying to always manage the total net worth of the portfolio or how much capital gains you make over a period of time, or where I found myself, which is looking at markets completely differently. And I look at markets very much like real estate investors historically look at their portfolio. Now, obviously, there's always capital gains involved, meaning real estate holders with such assets always think about offloading properties, but large rental operations aren't necessarily thinking about offloading properties as much as someone that's a house flipper that just rehabilitates a house. They have a different strategy. And the whole point of really where we've come to is entertaining these different strategies. Everyone knows, sure, buy low, sell high. Great. How much can we talk about buy low, sell high? I'm not too fond of just sitting at looking at technicals and charts all day long, and I much prefer a topic that is unfortunately absent in so much social media commentary, which is alternative ways to engage markets. And that's how we find ourselves where we are. That's how we've come to this topic of conversation, and that's why many folks return to the content that I have been producing. How do we find ourselves in a more sustainable uh, methodology for interacting with these markets? Okay, let's hit the topic. My back is absolutely killing me today. It's cramping left and right. I'm going to see how much content I could get out for you guys. Monetary policy evaluation, critical differentiation. I think of these topics like 5 seconds before stream, but I was doing some Twitter posts earlier this morning, and that's really how I come to this idea. And this is the most important thing. How do you evaluate these protocols and what do they reduce to at the most fundamental level? And it's all monetary policy. And the earlier tweets today were what's the point of reference for monetary policy? And that's the Federal Reserve and other sovereign central banks and how they manage their currency, how they create the currency, how do they create demand for their currency. Now, let's take a country, for instance, that's not the dollar. Let's say I don't want to talk about Russia. Let's keep it simple. Let's say a South American country that produces corn. Let's say Brazil. So how does Brazil create demand for its current currency? It manufactures goods and services that it exports, and other countries want to buy these manufactured goods and services. So in in that instance, other countries need to have Brazil's currency. Was it the lira? No, that's Turkish. The real, the Brazilian real. So they need to have reals so they could purchase real denominated goods and services. So there's demand. Now, the U.S. is in a very different circumstance. We have large exports of raw materials, but it's also the fact that so much of the world is denominated in dollars, such that every current country around the world needs to have dollars just in case shit hits the fan or we have a dollar bull market like this. So the dollar is held in reserve such that these countries can purchase things denominated in dollars. So there's immense privilege to um, our system. Such that we could print an enormous amount of dollars and the rest of the world just sucks it up. It's basically like an NFT market. They get slurped, the dollars get made, the dollars get minted, and they just get slurped out of circulating supply. And bonds and debts are a complexity strapped on, so that's just additional monetary policy that is really a capital control. So that's what I tweeted a little bit earlier. So what does the US do? The US creates bonds, treasuries, and sells them, which removes dollars from circulating supply. So the U.S. is basically purchasing dollars from circulating supply and giving a person uh, a revenue stream denominated in dollars and a future claim on the dollars that they locked up. So it's a time locked deposit. It might as well be VEUSD if you want to understand the way bonds work. And it has, whatever time lock associated with it. Let's say a 10-year bond. So it's a VE lock for 10 years. And you're going to get, 3, 4, 5, 6% nominally priced revenue stream. So those bonds are not like VEUSD. It's more like CVXUSD because bonds are portable and collateralizable. So not fungible like an ERC20. So maybe it's like an NFT type position. It's a non-fungible asset. But that's basically the global leverage system. So further incredible privilege offered to the U.S. currency as well as bond system. The global derivatives market is based on primarily U.S. sovereign debt. Debt around the world, but surely the vast majority is U.S. sovereign debt, U.S. bonds. So the U.S. is able to mint a shitload of dollars. Countries are purchasing it hand over fist so they could buy stuff that is US dollar denominated. And that's exactly why China and good parts of the rest of the world have purchased so much shit in the US. Well, the real estate, the business, the enterprise, the commodities, the manufacturing, because they have the dollars, and the U.S. printed them. And then the U.S. tries to balance this monetary policy by selling bonds and sucking dollars out of circulating supply. So anyway, we find ourselves to the point where the dollar, let's pop it over to the main screen and see how the dollar is doing today. The dollar is retreating a little bit on the global market. There's a little bit less demand than there has been over the last couple of weeks. There you go. It got rejected at about 104. Let's zoom out to the monthly. So my fear is that we're about here. Notice the similarity, the blow off top to about 104, and we fell down to 98. So interestingly, this was August of 99, and this is really where maybe the last thrust of the equities market occurred before dot-com bust. So that could be where we are in so many regards, but it's such a different macro landscape right now that we might have our last thrust in equity markets, the melt up that a few people have called for, and obviously a much more exacerbated melt up in the crypto space because the crypto space is significantly more volatile as compared to equities markets. So you get a higher all-time high and then just an extreme deflationary pressure across everything other than dollars. So if the dollar's ripping, everything else is getting completely creamed, especially foreign sovereign fiat. So some of the systemic differences include, can the system handle that kind of deflation right about now? Can other countries handle 120 on the DXY? Can the euro and the yen handle it? Probably not. So we have very big systemic differences now as compared back in 1999 and 2000. So those questions aside, it's pretty decent to see that we could have a bullish period if dollars keep retreating, which they look like they are. And bonds, let's go over the bonds real quick. Let's go over the 10-year. So the 10-year looks to have put in a historic resistance flip support and has been pushing back up all morning. This is quite remarkable. Um, these stories don't really tell us what's going to play out, but they tell us what's going on right now. And whether this falls through and historic resistance holds as resistance, I don't really give a shit because as of today, you got a golden cross on the weekly. Is it the monthly? We got a 50 SMA, two. No, that's a 10. That's a 10 and a 50 on the monthly. But on the weekly, this is a 50 SMA cross of the 200 SMA. That's extraordinary. It's a 50 SMA cross with the 200 SMA and the 200 EMA. So it's a strong golden cross coupled with an expression of support on historic resistance. Merely the expression of it is just indicative of how different this market is as compared to 1999. It's nice to see on the DXY 22 years of history compressed within a couple of, such a short or relatively small chart. I mean, look at this. This is 22 years of currency history right here in a little bit of lines on a graph. So we'll see how a striking comparison between August of 1999 and May of 2022 in dollar terms compares to a very different situation for the bond market, very different situation for global debt to GDP and nominal debt servicing costs compared to tax receipts of the U.S. government. It's just extraordinary difference from a macro perspective. So when we come back to the crypto space, I'll circle back around to the topic of the stream, which is how do you evaluate these assets? And the most important thing to evaluate really is survivability. If you've looked at assets that survived, it's QQQ, perfect. So if you looked at assets that survived 2000, this is the 2000 collapse, and check it out. Check this out. Let's correlate DXY with 2000. So that's July where the dollar topped. And look at that. So the dollar topped in July, that red candle, and then just melted up. So there's your final melt up. So inverse correlation, if the dollar breaks down to 98, in 1999 terms, this little drop down to here, I'll draw it, 1 second. This little drop down to here could easily account for a melt up to all-time high in equities markets and certainly the crypto space. Literally just in historic 1999 terms, this little drop right here, this little line on this graph can manifest this entire rip from this red bar up to here, which is huge. That's an absolute massive rip in historic terms if you get it bigger. You're talking about, let's get a price range on that, from the lows to the highs. So literally NASDAQ ripped 115%. That's crazy. Between a drop on the DXY, the pullback down to about just literally a 6% drop on the DXY. So if we go like this, and we take a price range, well, let's just copy it. Boop, boop. Copy it over, say about there. Oh, nope. So a 6% drop would put us at around, what was that, 6 points. That puts us at 98. So literally a 5-point drop, maybe a 6-point drop from the top is what accounted for the NASDAQ ripping 115%. It just shows you how powerful the damn currency is. The dollar is just such a wrecking ball when other currencies or other countries are hoarding it because they need it. They need it for security. It's just a very powerful asset considering how much of the global goods and services are denominated in dollars. That you really need it, and it's understandable. So it's to be respected. It's for us to have animosity towards it because of how powerful it is, but it's also really to be understood for how extraordinarily powerful it is and how much control it has over countries to such a degree that it's really a weapon of war, or if you look at it that way, or a weapon of peace and organization and coordination and I guess stability in many regards. It really just it whips people into shape. It whips currencies into shape. It's like, you want to do something. You want to do what? You want to go to war? Okay, we're going to raise interest rates 5%, and all of a sudden their currency domestically is completely crashing. So there's still a huge amount of power with the dollar. It has a capacity to literally ravage equity markets, as we've seen. You can see our recent bull trip down from February of 21 from 89 to the 104, February of 21. Nope. Well, there was still equities bullishness between February of 21 and the 104. So there was still, it's almost probably a 20-30% rip to the upside. Um, so there's that. What that shows is there's not correlation. There's periods of correlation, periods of inverse correlation, and it'll drive you mad trying to think of if something goes up, something else is going to go down. So this drives us back to the topic of today. It's not sustainable, and that's why I very much think it's much more healthy and sustainable to look at these protocols as enterprise, as cash flow machines, and ownership of a percentage of total cash flow going through a system. So how do you evaluate these monetary policies? You evaluate them relative to what history offers us, which is the Federal Reserve and foreign central banks. You think of them in terms of currency issuance. You think of them in terms of income as an enterprise, but what is a country but merely an enterprise that has income in the form of tax receipts, and they have expenses, and they have deficits. So most protocols in the DeFi space spend more money than their income, which clearly, from a U.S. perspective, is sustainable. We've had a deficit for a long time. We spend way more than the income that we make as a country. But it's also the US, so you can't compare that to a brand new DeFi protocol. So the vast majority of times when you see a DeFi protocol that has these very large incentive systems, 100, 200, 300% return, it's not sustainable. And they're basically comparable to a dividend on a stock where they're paying people more than the damn revenue of the company. Not only is it not sustainable, in almost all regards, it's self destructive. And you see it time and time again in the damn DeFi space. So, how do you survive this period of time in the DeFi space? Um, the question really becomes what is going to survive? Even a good protocol has a potential for failure. A great technology doesn't necessarily come to fruition, doesn't succeed. So, if you find a great protocol, at least it has the potential to survive. You got a shitty protocol, it's got very little potential to survive, and the odds are overwhelmingly that it will fail. If even a great protocol could fail. So, fall back on the damn monetary policy, and that will give you the best quantitative means of assessing the potential for a protocol to succeed. Now, I mentioned three protocols earlier this morning, and those are just part of what's available to evaluate. Clearly, Curve is systemic at this point. It has a federation that's mandated to put it into reserves. So, one thing we know from history is that a federation perpetuates. It grows directionally. If it's a growing federation, it's on the rise because so many protocols are putting it into reserves. other protocols are going to put it into reserves too, and new protocols are going to start putting it into reserves to compete for control over what Curve offers. And Curve has commoditized inflation, which they've commoditized their monetary policy, which ultimately is inflation, the currency issuance process. So it's very much an MMT currency issuer because of these dynamics. And MMT really purports that you can do whatever the hell you want with your currency as long as you have balanced capital flow and monetary pressures, particularly inflation and deflation. So in the instance of Curve, these federations and the momentum and directionality of the protocols that are placing Curve in reserves indicates their inflation is overwhelmingly sustainable. There is a currency shortage. Anytime you see the Curve price go up, it's a result of currency shortage, especially considering how much is created out of nothingness. So, what is the demand for Curve? And it's quite ingenious, the monetary policy, because the demand is the control over the monetary policy. You literally need, it's like having dollars. It's equivalent to countries around the world having to put dollars into reserve to be able to have weight in the decisions that the Fed makes with regard to bond issuance or Fed funds rate. Or other forms of monetary policy. In the instance of Curve, it would be like the Fed doing stimulus checks to companies or individuals, and countries around the world with dollars in reserve could vote. Hey, do we want to give X amount of dollars to a country or X amount of dollars to a group of citizens or a group of corporations? So that's what Curve has done. They've commoditized the governance of monetary policy, and the monetary policy is that of an MMT currency issuer as compared to the historic way the Federal Reserve operates their currency system. Is it the Treasury's currency system? I guess so. I guess it's the Treasury's money and the Fed's rules of how the money flows or operates, so on and so forth. But these are the types of things I think about, and that's why Curve is just really so systemic. It's not the protocol, it's not even the AMM. I guess it is part, but it's very much the comparison that can be made between its monetary policy and that of historic creators of monetary policy. It's extraordinary what has emerged, the federation of protocols. So there's a couple of protocols that are doing stuff as such. You got Balancer with eBal. You got Beethoven on Phantom. Qidou's doing interesting things, but these are all very small federations. So I look at all this shit as emerging markets, and you could compare them to countries and the size of the country and the size of the economy of the respective currency. And these other ones are small in descent, so they have an increasing likelihood of not succeeding and not surviving and not. It's really all about survival. If any of the shit survives, it's going to be very powerful infrastructure. So obviously, the one that has the largest potential for surviving is really Curve. I did talk about Frax as well. So Frax is very much erroneously compared to Luna. Frax is a very it has a complete capacity to maintain peg under almost all circumstances, unless it's just like something extraordinary. They have it's all how do they mint Frax using FXS and USDC. So a lot of folks find it distasteful that it could be 100% collateralized by USDC. I don't see that being the case. I see that actually as a very interesting thing. One, it'll be 100% collateralized by a dollar backed asset. And two, then it becomes a wrapped USDC with a strapped on deflationary monetary policy that is revolving around treasury management, which basically is a revenue producing entity. So it has overtones of a hedge fund, so it has a revenue stream, and then you get into the behavior of the Frax protocol, where it's what does its revenue do? Its revenue buys back FXS from open market, creates deflationary pressures, which gives it more of a capacity to balance the peg. So I love the Frax system, and I think the under collateralization is just a feature, and they could recollateralize it as needed, and it's just so barely under collateralized, like 89%, and they own that. That's the beauty of Frax. They basically own the vast majority of their liquidity. So as people are trading Frax and USDC or three pool in the instance of Curve, Frax, if Frax gets sold on the open market, Frax literally could just remove Frax from the pool to balance the pool. And if there's a deficiency in Frax, Frax literally has a capacity to min Frax. And then it comes down to under what conditions do you redeem Frax for the underlying USDC and FXS? When do you burn Frax? When do you min Frax? And that's really the brilliance of what Sam and team came up with these automated AMOs, which are just contracts that manage everything I just described automatically. It's completely automated. There's no humans making these critical decisions. And that's kind of what Doe wanted to get to. But he came about, he was just too aggressive, narcissistic in many regards. And, it built what it was, but clearly it wasn't sustainable. There was no resiliency in the network. He had no capacity. He went too big. He went across chains. It was just too much. What Frax did nicely was it grew organically, and that's what's happening with FPI as well. So, and that's what I talked about in my stablecoin paper, my article that I wrote. What's imperative is to always have a capacity to dominate the peg. If you have a capacity to always dominate the peg and under all circumstances, that builds trust. And if you maintain that and you prove yourself that you can withstand ridiculously volatile times, then you're really building a significant protocol that has high survivability. That's what it's all about. Now, Aave was a mention because of how extraordinary it is from a technology perspective, not necessarily from an investment. I don't think it's a good investment at all. I think the monetary policy doesn't offer much from an investment perspective. It offers no revenue. Who gives a shit if it goes up or down in capital gains? I could care less because of the way I like to think of a sustainable wealth management strategy. So I don't think it's a good investment at all, but I think it's absolutely breathtaking from a technology perspective. It's a goddamn money market bank. It has double entry accounting, how they talk about how much capital is in their system. Thus, it's a creator of currency. That's what the historic banking system did. And that's how currency creation is historically measured, and it's called monetary velocity, how much lending there is. And you combine lending with double entry accounting, you literally have currency creation. That's the history of commercial banking. So that's exactly what Aave is. It's permissionless commercial banking. That's remarkable in all regards. So it's not just the it's not just monetary policy evaluation that leads to survivability. There's obviously social media considerations, brand considerations. So even the best of technologies can fail. But it really comes down to these types of quantitative evaluations to assess the potential for survivability. And if something's going to survive, it's going to become systemic infrastructure. Let me help you guys. So see if you have any questions, and we'll do the best we can. Loki's in the house. Hey, Noah, love your work. Very happy I found your channel at the start of this year. Your insights are very helpful. It is a pleasure and an honor to present these alternative ideas, alternative strategies for evaluating these systems that we like to allocate capital to. And I think they're extraordinary pieces of technology that offer investments unlike anything available in the stock market. I can't stand stocks because stocks technically have it's a monetary policy. So you can look at it from that perspective, except it's completely controlled by the board. They could issue, they could burn, they could adjust supply, they could split and reverse split, so on and so forth. But it's boring as shit. You're talking about a traditional company with employees and salary and human resources and all the overhead that comes with a traditional company. But in the digital space, if you think digital is going to remain in the next 10, 15, 20 years and just keep growing, I don't see how genies go back in bottles. And these are companies, except they're protocols, except they're software, except there's no damn human required. There's no human resources. There's no labor. There's no insurance costs. There's no resource expenditures. There is zero overhead. It is the pure disintermediation of business cash flow. It's like Apple pulling in a couple $100 billion and giving it all 100% in dividends because nobody works at the company. It's just the company does what it does and it works by itself. So the opportunities in these protocols is paramount. It just doesn't exist anywhere else. And the problem is exuberance. The problem is people not expressing what these technologies are. They're talking about price point and what matters really is a frickin' entry into a market that gets exuberant. You know what's an interesting one? It's really Ren. Let's see if we could find the post this morning. Because Ren, let's see if it was the price bot Ren. Price bot? No, I don't know. So Ren dark nodes are pumping out about 30% returns right now. So obviously the price point has come down significantly, but the returns are incredible. Now it's 30%. So what happens if rent goes up 10x on the money? Now the returns get diluted. It'll be 3% returns per dark node. And now, oh, it's so unattractive. Yeah, well, when you bought it, it was 30% returns on the capital. So what happens is the returns get distorted by irrational exuberance, and then everyone gets obsessed with the price point. And really, what's pertinent is if rent goes 10x, if you get, let's say, if you get 100 grand worth of rent right now, you're making 30 grand a year. You're making 30 grand. If rent goes 10x on the money and that 100 grand is worth $1 million, you're still making the 30 grand a year. In fact, you probably be making more because if rent's going 10x on the money, the volume through the protocol is probably going to go a couple of multiples. So maybe you're making 40 grand a year, 50 grand a year. But now the APR is less than 10%. It's much more like 3, 4%. So everyone will be complaining, oh, rent's cranking out 3, 4%. Yeah, when you bought it, it was cranking out 30% APR. So the 3, 4% is the same exact amount. The 30% on the 100 grand is 30 grand a year. Rent goes to $1 million. The 3% is 30, 40 grand a year. It's very difficult to process that reality. And now the question with regard to the rent dark node, what's the odds of its survivability? Well, who's it owned by? It's owned by FTX. What's the odds of their survivability? What's the odds of catalog finance becoming, the Binance of DeFi? What are the odds? And so it changes the speculative bets significantly, as well as the calculation of where the allocation goes. When you think of things as an enterprise and a revenue stream and a salary and an employee and a pizza shop, we got to flip the script, boys and girls. We got to look at things from a different perspective. Asuan's in the house. Dominic, hey, Cap, out of work early today. Glad to catch you live. Very thankful to be learning from you for the last year. You've definitely helped me do better, and we can all do better, ladies and gentlemen. Breakless Rider, good morning. Dion, good morning. What's up, Noah? Rupert's in the house. Oh, I scrolled. Here we go. Joe, dollar monetary policies are driving nations toward Bitcoin reserves. Well, yeah, maybe. Bitcoin's another topic. I don't want to digress for this stream, but there's a lot of activity. A lot of activity. I mean, I like what El Salvador's doing. They got issues because they have a shitload of dollar-denominated debt, but that's independent from folks interested in alternative currencies and alternative reserve assets and the digital space and there's so much animosity towards either fiat and equally towards crypto assets and I see them all as technology, and they all serve their purpose. I don't like the weaponization of fiat. I'm not fond of that. And I'm not fond of the animosity. I'm not fond of the animosity towards Raul of late. I'm not fond of the animosity that bond maximalists have toward digital assets. I'm not even fond about the animosity towards the irrationally exuberant. Like, a lot of traditional finance folks that are very defending of fiat and bonds will be very critical of um, of people that buy like SHIB and other complete garbage. Now, I don't have animosity. I have more empathy. I feel bad. And that's why I focus on education and trying to help people and to know that that is absolute shit. Like Dogecoin is useless. It's useless. It's garbage. And we want to help people learn the topic that we talked about today, monetary policies and how it compares to central banks and the history of money and why it's really meaningful technology. And that's the difference. I just, you know, we could do better. Arts in the house, Matt Hawaii mortgage loan officer. Yes, indeedy. As Lynn said, can't sell $20 bills for $10. Not a great model. But you can, well, did she say that? Because that's what a bond is. Maybe not $10, but the point is a bond is selling, or is the US buying, let's say, a $20 bill for $10, $15 and saying, here, you could have a couple of bucks over the next 10 years as a stream. And after 10 years, you get your principal back, adjusting for the face value of the bond. So that's really what the U.S. does. So that's very interesting that you mentioned that and that she apparently mentioned something like that because that's literally what they do. They sell or they buy dollars for future dollars. That's what a bond is. The big twat's in the house, my man. Link to the paper. The paper? Probably said something earlier. Kingsley, Captain, this market has been beat me down. Didn't think I could lose so much money in such a short period of time. Concentrate instead of diversify. Focus on the foundational infrastructure instead of going out on the risk curve. Now, clearly, Phantom over 2021 was like the cheaper Ethereum, and everyone was going irrationally exuberant on Ethereum mainnet, and gas costs were completely through the roof. But guess what? The market's really like probably either late 2018 or maybe even it's comparable to late 2019, and we're going to go into a crisis, and then you got fiscal juice that juices the system back online. So right now, it's not Phantom, it's not Avalanche, it's not even Arbitrum or Optimism or ZK rollups or whatever, what have you. It's their mainnet, and that's what's hot, and that's where the risk isn't. Now, the biggest thing about risk is that people chase yield. Yield is proportional to risk. So you see a lot of criticism about Bancor, and I'm like, holy fuck, this protocol is crazy. And they're so obsessed with the fact that it's cranking out like 1, 2, 3%, like 2%, 2.5%. First off, it's off DAI, so it's over collateralized stablecoin. So this is a very comfortable stablecoin, in my opinion. And this is 2.5% of free money, nominal free money. I mean, it's relatively trivial amounts of money, but over a month, if I get an extra 500, $600, yay. What catches my fancy is that it works. And that's extraordinary. So if this gets scaled and they do everything I know that's going to roll out with Bancor, which is obviously the countless pools from V2 will get converted over to V3, and they have their auto compounding of the BNT, and then the vortex, and the market gets exuberant again, and BNT goes up in price, and people are vote locking. So there's obviously, and these positions are also portable and fungible and collateralizable over time. So it's V3 is an extraordinary monetary policy, as well as protocol and evolution as compared to V2. It's V2 plus plus. So I'm very, very excited about this. Now, BNT, that doesn't belong in a portfolio. It's extremely volatile. Now, bear in mind there's 83.51% lock, but that doesn't mean anything. That just means supply is restricted. Supply being restricted doesn't entail price go up. That entails there's less supply, which means price go down and up faster because there's less supply. There's more dollars chasing less supply, which means it's just increased volatility. So when you see a large amount of circulating supply disruption, that's mostly indicative of increased price point volatility, not price go up. I don't have a lot of BNT. I don't think it's a very good investment, but that is completely separate and apart from me thinking this is a ridiculous protocol. This is ridiculous technology. You know what's going to survive no matter pretty much no matter what in my mind this bear market? Bancor. This thing's going to stick around. This is crazy technology. That has nothing to do with the fact that I think the price point of BNT is going to get completely slaughtered. Separate and apart, independent. I wouldn't buy BNT, but I have an extremely high opinion, maximally high opinion of the software and the protocol. Now, that the point of me saying that what I just said over the last 2 minutes about Bancor is that there is an independent relationship sometimes between the power and awesomeness of the technology and the price point of an asset. You can have the most profound technology that's just not a good investment, but that doesn't diminish how freaking awesome the software is. I am just starstruck with what V3 does. It's incredible. Last couple questions. We're going to wrap it up. Let's see if I can help you guys. Ubenjamin, two. What do you think about STF, the maintained peg? I don't think about it much. It's a hot mess. That's what it is. Really nice perspective on the stock space with the amount of human control. Great insights. You're welcome, Loki. One curious view, my man, JM. Hey Noah, current landlord and house flipper looking to diversify into cash flowing crypto and trying to understand the bond bubble better. Any thoughts from you on this? Remind me on Wednesday. Happy to talk about it, my friend. Adam, re-assets being good technology but not great investments. Just what I was talking about. Is there an argument that because they have gov rights, fee sharing is like in the future, network effects might make it worth buying? No. Don't think about it from a worth buying perspective. Right now in this market, think about these protocols from a survivability perspective. What has the potential to survive a devastating deflationary system. Now you are in survival mode because anything that comes out of survival mode and makes it into any upcoming bullish markets is really going to be thought of as systemic infrastructure. And it's probably going to be few and far between protocols. A lot will fail. Ren is an interesting way to mine BTC. If the price corrects down, get a dark node. So I was cranking out 33% on the money. That's crazy. And it pays you in pure BTC. Not even wrap BTC, pure BTC. That's pretty interesting tech. Think they were referring to a link in your... Oh, my stable paper. Medium? I could give you my stable paper. It needs updating. I'm going to get back to it. I want to review it. I haven't looked at it in a couple of months. I'll pump it on. I'll put it on Discord. Cap, do we trust this mini pump? Fuck no. Hell no, Booster. There's no trusting pumps. There's no liquidity in the market. There's only hope. And don't hope. Do not allocate on hope. You need cash. This is a period of solvency. You got to have cash so you can pay your bills. The same thing I tell you guys about survivability. If a protocol survives, it's going to do very well in the upcoming markets. Now, you have to make sure you survive. You're the protocol now. You need cash to pay your bills. This is not when you do anything with regard to risk, boys and girls. Joe, F is hot now, but what happens in the event that DeFi goes mainstream? Isn't Ethereum going to encounter the same problem it had 6 months ago? There's nothing wrong with expensive gas fees. It's going to price a lot of people out of the market, and then the other protocols. That's exactly why Phantom and Avalanche were so hot, and that's exactly what Arbitrum and Optimism are going to do extremely well. They're going to accommodate cheaper fees. Now, what will happen is the vast majority of protocols, let's say 5, 10 years from now, an Ethereum transaction is going to be 20 grand. I'm just saying what's probably going to be the case, and what I see is what plays out. Ethereum transactions are probably 10, 15, 20 grand nominally. But we won't be operating on mainnet. We'll be operating on Arbitrum, ZK rollups, and Optimism. That's what I see playing out. Simple as that. For pennies. For pennies. You see what I'm saying? You're going to be operating on the rollups for pennies. Mainnet, nobody's going to be using. Maybe the big mega banks will be using mainnet because they want that instantaneous finality. Whereas with the rollups, they batch the transactions, which is why they're so cheap to get 100,000 transactions in one mainnet transaction. So they split the cost. Um, so that's likely directionality that I see playing out. When do you think the crypto top 100 will be full of efficient protocol tokens? I have no idea. What I know is that the top list will be constantly changing, but they will trend towards efficiency. That's very well said. Another issue I see is, as you articulated, people can make great tech, but the token surrounding it is awful. Now, bear in mind, uh, they're not necessarily awful. They're okay, fine. Uni is awful. Uniswap is completely useless. There's literally zero reason to buy it. At least Aave built the security module, and BNT is you stake it and you could get return, which is accessing the cash flow of the protocol. Except it's not optimized right now. So why is the price goes down? Because there's no real incentive to buy it. Why is the curve price holding up so well? Because there's extremely powerful reasons to buy it, and that it's a very difficult thing to achieve from a monetary policy perspective. Um, very interesting stuff. I don't know where I see Matic. Well, Matic, Polygon. Polygon's a big deal. Polygon fits into Phantom and Avalanche type conversation. 43 people in the stream, 20 likes. We can do better. But I thank you all. I really appreciate it. Monday, May 23rd, 12:19 p.m. As always, tell everyone to subscribe. I will see you all on Wednesday after party on Discord for the most rational community in the crypto space. If anyone needs me, noahseidman.com. Twitter profile has all the info. I will see you on Wednesday. Peace.